we're officially live on Facebook for the Thursday edition of the Not Your Average Investor Show, the JWB Rental Income Property of the
Week.
I am your host, Pablo Gonzalez. With me, as always, the man that I affectionately call GC because of his genius concepts, because he knows how to generate cash flows, because he's a great co-host, and because his name is Gregg Cohen. Say hello, Greg.
Hello, everybody. Great to be with you.
And normally on the property of the week, I'm the second smartest guy on the call, but today I have the honor of being the third smartest guy on the call because we have a guest analyst with us, a JWB investor, transplant from Chicago to Florida. He lives in the Orlando area. He's a retired sales guy. His name, Sean McInerney. Welcome, Sean.
Nice to be here.
It is good to have you here, Sean, and it's great to have the Not Your Average Investor Show community already filing in here. I see y'all in the chat lighting it up. Like we like to say, if you want to find out about owning rental income properties in your portfolio, you've come to the right place. If you want to find out about owning property management practices for rental income property investors, you're in the right place. And if you want an edge on the Jacksonville market, because you're a real estate professional looking for some opportunities, you're in the right place. Next place to go is chat with JWB.com. We also would love to encourage you to download the worksheet from today's property that we're going to be looking at. Joanna, our community manager, is with us in the chat. She'll share it. But if you want to go to jwbinventory.com, download the sheet, play along at home, that's going to be plenty of fun for you. And it's a super, super useful sheet. So I highly encourage that you play along. And now it is time for a little tradition that we have. It's called the roll call. You ready for the roll call, Sean?
Yeah, absolutely.
Let's go. All right. Lee Bishop. Hello, Greg and Pablo. Nice to see you again. Nice to see you, Lee. Leo F is calling in from California. Good morning, all. John Henning is saying good afternoon. Nadeem Shah, good morning, good afternoon, everyone. Nadeem coming in from the West Coast. We got Leslie Wilson. Greetings from Leslie in Denver. Greetings to you, Leslie. I bet Denver is wonderful right now. Drew Barnhill, good afternoon, you wonderful people. Good afternoon to you, Drew. Anthony Dida is in Jupiter, Florida these days. Anthony, that's I love Jupiter, Florida, man. Good to have you on board today. Carl Thompson calling in from Chile, Colorado. Carl, welcome. Who else we got? We got Bill Shields with his bilingual greeting. Que pasa, amigos? Good to have you, Bill Shields, on here. Greg Stone, howdy from New Jersey. Sorry. Howdy, Greg. Marilyn Cotterman from Homosassa, Florida.
Home of the manatees.
Home of the manatees. She says, hi, team NYAS. Good to have you, Marilyn. Jen fills in, the godmother of the Not Your Average Investor Show community. Writes in, good morning, JWB family. Good morning, Jen from the West Coast out there. It's morning for you. Who else we got? We got everybody greeting each other in the chats. Am I missing anybody that has checked in with us? I'm scrolling. This does not make for good radio. Dean Curry is checking in from Ohio. Good to have you, Dean. If I'm missing anybody, it's because I'm scrolling through the chat. Just check in with me. It's good to see you. I want to say your name here on the show. But as you can tell, this is a community-driven show, and I say we get started. Sean, we're about to jump into this property right now, but just give us a little scope, man. How long have you been investing in rental properties? Kind of what's the size of your portfolio? You wanna give us a little background?
Sure. As Greg mentioned, my oldest daughter was really, really good friends with Gregg's sister from college. And my daughter said, hey, there's this guy, the brother, Gregg Cohen, has got a company that does passive real estate investments. And I gave Greg a call, drove up to Jacksonville from the Orlando area, and he did a really smart thing. He took me to a home that JWB was renovating at the time. And I'm walking through this going, oh my, what are you doing? This place is a disaster. And he said, don't worry. And then we drove 10 minutes away to this house that it was total before and after. Fresh paint, you could smell it, new carpeting. And Greg said, this house was worse than the one you just saw. So I was like, okay, you got me. I got to see what's going on here. So that was the end of 2011, early 2012. And we ended up buying 3 homes on Indy Avenue in Jacksonville. And I know your audience is not going to, they're not going to like what we spent for them, but they were contract, you know. So
Little
we
teaser there.
purchased new.
The
We
purchase
purchased
price
new
that
property.
Sean was able to get was a little bit different than what you're going to see here,
Yeah.
as you stick around later on the show.
And it's like everybody else. So we, as I've said to both these guys, boy, if we could see the crystal ball, I would have bought more of them. I would have scraped everything I could to get these, So we've got the 3 in 2012 in India. And then we got 3 more the next year because everything was going so great. And JWB is a top-notch company and everything just flowed from there. So we've been involved almost 10 years now. Next May, it'll be 10 years. Pretty incredible.
It has been incredible. And, Sean, I know in my decade plus of working with you and way longer than that, my family and your family being close, that, you are not an individual who, jumps, just because somebody says there's a great investment opportunity. I know how important it is for you to understand and do your due diligence, not only on the investment opportunity, but on the team. And, let's be real. In 2011, that was 10 years ago. I was 10 years younger, and I did not look like the most experienced individual in real estate. I'd like to think my team and I were probably the most passionate, but we did not have a lot of gray hair and a lot of experience underneath our belt. So what on earth motivated you to invest 6 properties with the brother of your daughter's best friend, right? Like, how did you take that leap of faith? Because I know it wasn't a natural process for you.
Well, I always looked at real estate as being important. Okay. And if you take a look, my wife and I had IRAs like everybody else over the years. Well, guess what happened between 2007 and 2010? Okay.
Mm-hmm.
I was looking for diversification, and that was the main thing. And I ran the numbers, and if we were able to get the rent that we anticipated getting, we'd have excess funds each month after paying the mortgage and everything else. And I got to try this out. So we went to the 3, and then things were going so well, we did the 3 more the next year. But the answer to your question is diversification. That's what really, and I just had a good vibe about JWB. I mean, the follow-up, the total, constant communication, things like that was a big deal for me.
Love it, Sean. And knowing a little bit of the backstory, right? I know that we're going to get into where that vibe kind of got tested for a little while,
Mm-hmm.
and just how passive of an investment this was for you. But for right now, we are going to go to the property and see what you've learned in the last 10 years and maybe a trip down memory lane of the first time that you were looking at one of these sheets as we magically whisk our audience away here to 8601 India Avenue in Jacksonville, Florida, 32211. It's a purchase price of a home of $206,000 for a 3-bedroom, 2-bathroom, 1-car garage home that is leased at $1,275. There's a picture of it here. I'm describing it for our friends that are listening in the podcast in the future here when we repurpose this thing. And a total estimated conventional financing, total monthly cash flow of $118, and an estimated conventional financing ROI of 7.54%. Sean, when I pop this property eval, first of all, let me know in the chat if you can see it clearly. Sean, let me know if you can see it clearly.
Oh, yeah.
But when I pop this thing on here, what's the first thing that comes to mind as you're looking at this thing?
Great looking property. We were just talking, I just confirmed with Gregg, the 3 homes on Indy Avenue that we purchased were 4 2.5s. It's a different climate now. Okay. Back then, you could basically get, and maybe you remember this, Gregg, we talked about a property for, let's say, $100,000. You'd be looking at $1,000 rent.
Mm-hmm.
1,200, 120,000, you're looking at $1,200, you know, that ratio, approximately. You're just not going to get that now. Building materials and everything else. It's just not the same. So this is a modified version of what we were able to do, you know, 10 years ago, but that's the function of the times, you know. I like the fact that there's a 2 or 3 year lease. That's huge. And got the 1-car garage, the minimum, you know, we always look for a minimum 3 baths or 3 beds, 2 baths. But India Avenue is a decent neighborhood, and JWB puts homes in areas where you have a chance. So
I think it's always
these numbers
really,
are a little bit different than what I would, you know, had 10 years ago, as Greg can tell you, but still versus what's going on today, I mean, this is excellent.
Well, I think it's always really interesting to spend some time inside the heads of our investors who made those decisions in 2011, because Sean, just like you mentioned, it's a completely different value proposition today, right? In 2011, that was the very most bottom point of the housing market recession and crash. And I mean, you had everybody running away from investment properties. No builders were building, right? You didn't want to be anywhere near a real estate investment at that time. So you really, for the folks that were buying properties in 2011, they really had to have a commitment to the fundamentals. But if you listen to the outside noise, real estate was never going to appreciate again in 2011, right? The country was completely scarred by it. So there was the growth conversation was very different than the growth conversation than we have today, right? Today, I've been talking for over a year now about how we've expected home prices to go up at a rate that's faster than the normal appreciation rate. And guess what? We've seen 15 to 20% appreciation this year. And guess what? Next year, we expect home prices to go up more than normal as well. So we have these leading indicators that are very strong. You didn't have those back in the day. But what Sean had back in the day was a rent to price ratio that was much more favorable than what we have today.
Yeah,
right? When he's talking about $1,000 rent for a $100,000 property, he's absolutely right. So it's a different value proposition now. And depending on how you invest, you can say that it's better now, or you can say it's worse now, right? But it's just different. And I think you had to have a lot more guts to invest in 2011 as not a real estate professional to invest in those turnkey properties like Sean did, because it was a scary time for everybody, for sure.
Yeah, I appreciate what you said. The other thing that is important is that, Greg, you and your team did a very good job of pointing out how unique Jacksonville is and was. And that was another, domino for me. When I was just doing a little research, you go to Atlanta, Memphis, you pick a city. I mean, how could you get the same kind of return? I don't know the explanation, but Jacksonville was very unique, and it's worked to our advantage in a big way.
In your words, Sean, what makes it unique? Like, what was it that stood out to you that made it unique, that made it attractive versus these other cities?
Well, it's a simple fact that back then, and I hate depressing people, listen to this. I mean, $102,000 house, and you could get a 4-figure rent. Bottom line, if you wanted to get $1,000, $1,100, $1,200 a month rent in any other city, pretty much, you had to spend a lot more than $100,000. That was it. The ratio that Greg talked about, that was like boom. That's why we made the move.
It sounds like, and Sean, I know how conservative you are. It sounded like while everybody else was concerned about the value of real estate, wow, is it going to crash? Is it going to keep going down? You looked at it from a different perspective, which was how much positive cash flow am I getting every single month? So that the noise about appreciation or depreciation at that time didn't really affect you. You were comparing, what can I receive in bonds, right? Or what can I receive in CDs or other typically conservative asset classes. And you're comparing the returns from those asset classes to the cash flow from rental properties. And you're like, this is a no-brainer, right? As long as Gregg's team can do the property management well and keep this thing rented, and as long as Jacksonville as a market supports that with a strong job base, this is a lot less risky, it seems like, is what you came to the conclusion.
Cash is king and cash flow is king. Nobody could have predicted the home appreciation that's going on everywhere, certainly in Jacksonville, amongst others. And we knew over time that these homes were going to appreciate, not like they've done the last 3 or 4 years. I mean, this is incredible. So Gregg's exactly right. The key was, cash flow. And if you got renters paying your mortgage and you got some extra, we didn't even talk about the tax, advantages. Mm-hmm. I mean, we put all those things together and made a decision. It's a smart investment to make.
So let's talk about this cash flow here, right? Because we have, we talk about it a lot on the show. What people are buying is this cash flow and this ROI in a passive way, right? So when you look at this $118 a month in cash flow, Sean, what do you think of it? It sounds like you had a higher cash flow back then, but you just kind of mentioned that what drew you in was the fact that somebody was paying your rent. How much weight do you put in the monthly cash flow itself?
Again, our monthly cash flows are a lot, better than this, to be honest. But when you take a look at what are you making right now for somebody just stepping into the picture right now? What are you making in savings accounts? Things like that. And to me, it's a combination of, hey, if I can make, a couple grand a year in profit, plus I know I've got the appreciation, plus I have the tax advantages. It's a great investment. It really is. And where are you going to make 8%, 7.5% these days, and you're just going to add to it, you're going to add to it when this $206,000 home is going to be $216 in 8 months or whatever. I mean, I think about all those things, not just the monthly cash flow, but the fact that you have extra cash coming in is a beautiful thing.
It's a beautiful thing to hear an investor look beyond just the cash flow. And Sean would be one that would be, I think, more suited just to look at the cash flow because he had such a positive experience when he purchased some 10 years ago. But he's looking beyond the cash flow. That's a beautiful thing. Most investors don't do that. They make their decisions just based on cash flow because that's the easiest thing to do. But you hear him talking about tax savings, talking about home price appreciation, right? We have principal pay down. So all of Sean's residents paying down his loans for him for the last 10 years. That's a pretty cool thing. His loan balance is a lot lower now. And then, of course, we've got inflation hedging, which is the fifth profit center, is one that has gotten a lot more of the limelight lately because we're in inflationary times. Mm-hmm. Right? The consumer price index, I think it's over 6% now. I think it's the most it's been in who knows how long, right? There's nothing better than holding a hard asset that has debt on it as well, right? The debt is not inflation protected, meaning that whoever's lending you that money is losing money as inflation happens. It gets easier and easier for you to pay that debt down in inflationary times. And that's why this investment makes sense, right? It's not just the cash flow. If the only profit center was cash flow here and you compare that to your other asset classes, it's not going to stand out. For this to make sense for everybody, it's got to be that type of an approach like you hear from Sean, which is all 5 profit centers. And then it becomes, something that people get really excited about.
Mm-hmm.
All right. And Gregg, do you want to kind of just give us a quick breakdown of the difference between this monthly cash flow and this total ROI so that we can get a little deeper into Sean's story here?
Love it. Love it. So And Pablo, would you mind zooming in there a little bit? I think it's a little blurry on my end. So
Yeah, it's blurry
we'll
on my
zoom
end
in there.
too.
Yeah. Sometimes that, just shows up just to mess with Pablo a little bit. I think I programmed that into the show just to keep him on his toes.
Keep me on my toes. Keep me on my toes.
So we're looking at this estimated conventional financing total monthly cash flow number here. And for all of our new folks that are just joining the show for the first time, thank you, welcome. This is the first and most important thing to pay attention to when analyzing a rental property investment. Total monthly cash flow is like the entrance to the dance. It is your entrance to potentially investing in an asset like this one. As you've heard from Sean, total monthly cash flow is really important back then. It's still really important right now. We'll be honest and we'll say, listen, nobody's getting the type of cash flows that Sean got 10 years ago. He was an early adopter and the market was very different than it is today. But the great news is that you still have the opportunity to get positive cash flow every single month. When you see $118 here, that's saying that when you've got the rent coming in every single month and you take out the normal expenses that happen every single month, like your principal, your interest payments, your property taxes, your insurance costs, your property management fees, you're still left with an estimated $118 on this property. And don't get so caught up on whether or not this is $100 or $125 or $175 or $50. The key here is that you have to have an asset that pays for itself every single month for this to be under consideration. And the reason that's important is because that's risk mitigation for you. No matter what happens with the price of the house, if it goes up, if it goes down, when it's paying for itself every single month, including all of the costs of the debt, then time's on your side, right? You're in the driver's seat because your risks are mitigated because it's paying for itself. It also allows you the opportunity to become scalable in your portfolio. Like Sean is able to buy 6 homes. If every time Sean bought a house, he went negative $100 or $200 a month, and by the time he owned 6, he'd have thousands to potentially pay each month just to hold the property. He wouldn't be as excited about buying more properties and holding on and building that portfolio. So that total monthly cash flow is what happens on a normal month for you. The most important thing is that it is positive. That's risk mitigation, and then that's scalability so you can accomplish whatever your passive income goals are.
So that's the monthly cash flow, right? Like the every month kind of typical experience, and then the estimated conventional financing total ROI is more of like a holistic picture, right?
Mm-hmm. Yeah, and if we kind of step back to the conversation that Sean started, it's looking at all of the profit centers. Now we can go just beyond only cash flow. And this estimated return on investment is really your ability to be your own manager of your funds. You're your own asset manager in a sense, right? Your job is for your money to be performing. And the measurement for how well your money is performing and working hard for you is what is your return on investment. Right now, the market in Jacksonville is bearing between 7 to maybe 8, maybe 9% for your estimated return on investment. And that takes into account all the things that happen on a normal basis, like we talked about with cash flow. It also takes into account some of the good things that happen on an annual basis, and it takes into account some of the bad things that happen every once in a while. So those additional good things would be, like Sean said, you've got tax savings is another profit center for you. That's this amazing amount of tax advantages you get just by holding rental properties. You get these amazing tax savings. So it's including that. It's also including the amount that your resident is paying your loan down for you. That's principal pay down. So when they make the payment of rent to you every single month and you pay the mortgage, well, because you have something left over, what's really happening is they're paying your mortgage for you. And so that's included in that number. But what's also included are the negative items: maintenance cost, vacancy cost, tenant placement fees, things of that nature, which can be costly, don't happen every single month, don't happen every single year, actually, but will happen over time. We include that in there as well. You take all of the good things minus the bad things, and you divide it by your initial investment. And that's how you see how hard your money's working for you. And this one right there at 7.5%, which is where we love.
There you go. And can't help but notice, Sean, when you called out this 7.54%, right? You were just talking about where else can you get this investment? But we know that a lot of we were just talking about this idea that you bought this home at $100,000 and now we're selling a home on the same street for $206,000, right?
Mhm.
And that's appreciation, right? That is not contained in this analysis. Was the appreciation contained in the analysis when you first saw it, or was it something that, how did you think about appreciation before you invested?
I thought appreciation would be more of a much steadier line. So nothing like what's happened, as I said, the last 3 or 4 years. We're fortunate enough to have double-digit return, and that's just the way it is. I mean, you have less of a mortgage payment each month and that kind of thing. But in answer to your question, any kind of appreciation was a bonus, a real bonus. We never really looked at that as being a major component. If it happens, it's great, absolutely great. But it's not what it's not your decision maker. What your decision maker is, you're paying down your mortgage, you got the tax benefits, those kinds of things, and you got some money left over. I mean, it's a great thing.
Yeah, love it. And GC, why don't you put in, why do you have it here at 0? Do you think that homes are not going to appreciate? Is that what's going on here in Jacksonville right now?
I don't think that's going to happen. I don't think that's going to happen this year. I don't think that's going to happen next year. And I certainly don't believe that homes are not going to appreciate. I certainly believe that homes are going to appreciate this year, next year, and over the next full real estate market cycle. But you're right. I put 0% there. And, the reason, again, it's been great, Sean, having you on the phone, on the call here, because I'm just going to piggyback on a lot of what you say here, right? You affectionately pointed out that, like, comparing this asset class to your other potential places you can put your money, the fact that you get this monthly recurring revenue and you can make 7.5% on it, like, you just don't get that other places. And so we really are big believers in under promising and over delivering. And so when my team and I are thinking about how is the best way to put this asset class forward and set our clients up for success, the fact that we have a wonderful investment here that produces 7.5%, that produces monthly income, right? And I don't have to show all of the bells and whistles and all of the wonderful potential opportunities to make money on this thing. Well, that's a wonderful thing. I don't have to show the very most rosy colored glasses when it comes to this investment portfolio. I know that's been a really big part of how we brought clients on for many, many years, going all the way back to when we brought Sean on board, right? Under promising, over delivering. And if you can just do a little bit better than what you told people you're going to do and do it consistently, you're going to have a client for life. So that's a couple of the reasons right there, right? The asset stands on its own 2 feet compared to other asset classes, even if we don't talk about home price appreciation. And then the key for us to live to our core values and to work with clients to according to our core values is to under promise and over deliver. And the fact is, Jacksonville is positioned for growth now, next year, and over the next full market cycle. That gives us an opportunity to perform just like we have for Sean, which is over delivering versus what people sign up for.
So let's talk about that, GC, right? So historical home price appreciation, 4.3%, right? That is what we can bank on over a full market cycle. Once you plug that in, obviously right now it's way higher than that. So you kind of got a little baked in upside, but we're going to under promise, over deliver here. Once you put that into this evaluation, if you are going to hold on to it for a full market cycle, you pop it in here. You can do this at home, and it shoots up from 7 and change to 23 and change. Sean, do you want to take a shot at explaining leverage?
Well, when I did the analysis, okay, and I remember doing this in 2012 and 2013. It comes down to using other people's money, as they say. When you're able to use other people's money, your percentage goes up, way up. And yes, you get X amount of hundreds of dollars more in your pocket each month. But when you're able to put, just 20% down and all these numbers are the same, the leverage far surpasses if you just paid for it, cash outright. And that's why we got into financing the homes. I mean, it's a big difference. I mean, you can see right here. That's why we did it. Until you sit down and run the numbers and see what, after all the expenses, including your mortgage and everything else, the percentage makes so much more sense to the borrow and leverage it. So I remember, I don't have the figures because it's been 10 years, but to me it was a no-brainer. I'm not gonna, hey, all of us love getting more money back each month out of the investment, but what's really going on here? What's really going on is you have a better chance of the total return on investment by putting just some money down and use other people's money.
And in an environment where home prices have gone up at a rate that's faster than normal, which is the environment for you, Sean, over the last 10 years, your decision to take advantage of financing has rewarded you handsomely, right? If we compare this, I know over the last, since 2012, home prices in Jacksonville have appreciated about 9% per year on average, 9%, about double. Well, if Sean just bought those properties in cash, he would have earned 9% return on investment just from that home price appreciation because he wasn't using other people's money. And that 9% is wonderful for home price appreciation. But if you compare it to what actually Sean has lived out, which is why he's so ecstatic, is he used other people's money. He put 20% down. And when you put 20% down, it's like you're taking that return on investment number and multiplying it times 5.
Yep.
So that 9% return from home price appreciation for Sean has become 45% home price appreciation, 45% return on investment from home price appreciation per year, right? That is what he has lived out. That's the beauty of investing. Number one, for cash flow, so you mitigate the risk, and then choosing the right market, which is positioned for growth and holding on for the long haul. Sean, you're a picture of investing genius over there, my friend.
No, you're the genius next to Pablo. Pablo, I'm never, I don't have any second thoughts about, doing the mortgage route. Believe me. I mean, as Gregg just said, it's a grand slam home run. I mean, it really is.
Yeah, that G and GC stands for genius. I say it all the time. I'm glad somebody agrees with me, Sean. I appreciate you, man.
All right, that's enough of that. Now let's talk about, I'm going to take the reins here because this is going wildly off the rails. You guys are being way too complimentary. Let's talk about, Sean, let's talk about some of the challenges that you have experienced. We talked about the amazing positive things that have happened, but you and I both know it hasn't all been rosy. Can you share some of the more challenging times? And don't hold back. Go full transparency. I know everybody would love to hear it.
Well, 2012, as I mentioned to you guys before I got on the call, 2012 was, we get the monthly statements. Gross income, JWB takes their property managed percentage. We get the rest. Home run, month after month after month. And I said to my wife, we've got to do this again. So we invested again in next year, 2013. Same kind of thing started happening, lasted a few months into 2014. I say the tail end of 2013. So the end of 2013, all of 14 into 15. You know what hit the fan, okay? We had every kind of scenario. And as I mentioned before to these guys, the term that was used was outlier. And it was not in a good way. I mean, we had so many things happen, I can't even list them all. There's so many. I put it this way. We had 20 years of typical bad experiences in like 12 to 18 months. And the only other person at that time who had the same kind of experience was, the co-founder, Alex's mom. It made me feel a little bit better, but I started feeling bad for her too. It's like her own son got her into this thing, I mean, what are you going to do? So we had some, they weren't shouting matches or anything like this. We had very, passionate arguments back and forth. And I'll tell you what really helped me psychologically or mentally was I never sold any of the stocks in the IRA back when the financial crisis hit. And they started improving. And I'm going, you know what? And Gregg said, to his credit, he said, John, if you want to sell now, you can sell now. But you really bought at a very good time. Even Gregg didn't know that at the time. But I caution everybody out there, you're going to get a property turn that is going to be expensive. You're going to get renters who, don't treat your property like they should. I mean, there's all sorts of things. We had a person who got evicted who broke it back into one of our properties and stole the appliances. I mean, just crazy stuff. Is like, where'd that come from? Things like that. But I mention this in all honesty. The two big things that really have helped, JWB, I think, got a lot better at screening applicants. I don't know what they did internally, but I think it's made a big difference. And as I said to these guys, the multi-year leases, huge. And you can say, hey, wait, I just want to go month to month because if rents go up 20%, I want to get that 20%. Don't think about it that way. It's not worth it. Take the 2 or 3 year lease, maybe get the incremental $50 a month in rent or whatever, and it's going to save you in the long run. I got to say that. I'm trying to think. The other thing we talked about, what we started doing is not using carpeting and putting the laminate floors. That's going to really help you folks. If you do invest, it's going to help you big time in the property turns, because you won't have to do that repetitive, clean the carpets or fix the carpet, or put all new carpeting in. Just don't even worry about it. I think by statute, you only have to have the carpeting on the stairs, I think, like if you have a 2-story, but that's kind of thing.
Yeah.
But in answer to your, what Gregg started off as saying, if you think you can own anything and have a smooth ride, it's not going to happen. So as I said, we went through, it was horrendous.
How close were you guys to selling? Just curious. I remember sitting down with you and Joan and your wife Joan, and we were sitting down at breakfast, and I said, I don't know if they're going to hold on. I don't know if they're going to listen to me. How close were you guys to selling?
It wasn't like we were at the end of the plank. We weren't there. We had maybe a couple steps on the plank, but
I was worried you were going to throw me off the plank.
No, that's really, it's a function of humanity. I mean, you get people who come in and it's like, how do you people live in your lives? It's, it's just, but I think the requirements, the attention to detail and everything has really helped as far as being in a better, clientele in there. And it's worked, but we were not super close to selling. And I think we decided, let's give it another year or two. And that's what happened.
Yeah.
So.
Well, you're right. You guys took it on the chin in 2014, and we'll kind of show what this actually looks like so everybody can see beyond just the story here. And it's just real. And you know what? This can happen when you have multiple properties. Can bad things happen in bunches? Yeah. And that's what Sean faced. couple things to point out there. You know, when Sean started to invest with JWB, it was 2011. We were 1 year into our property management business at that time. We were 5 years into our company at that time. I don't know how many people we had on board, but I can tell you it was a lot less than we have now. And of course, the talent level at JWB continues to get better and better every year. But overall, I mean, we're 10 years more into this business. So again, I like to compare and contrast what Sean was able to invest in back in the day versus what he's investing in now. And it's easy to look at these returns that Sean has, and it's easy to look at the purchase prices and say, oh, geez, that was a much better time, or that was a better deal. But you might not always think that. I mean, let's talk about the carpet versus hard surfaces in the floors, right? When Sean bought properties with us, there was carpeting throughout. For my properties that I bought in 2006, 7, 8, 9, 10, 11, there was carpeting throughout. Now, when we look at this property that we just featured here on India Avenue, for the client that owns that property, there's hard floors throughout, right? Over the years, Sean, when property turns have come up, has decided to upgrade his floors, has incurred that additional cost, right? Now, you don't have to do that with JWB because that's built in. Our repairs and our renovations, our constructions continue to get better and better and better. Of course, our property management, our course screening has gotten better and better and better. If it hasn't gotten better in 10 years of doing this and managing 4,500 homes, then we got some problems, right? It continues to get better and better and better. So I think it's really easy to point out that it's not exactly comparing apples to apples. And there were advantages for Sean back in the day, and there are advantages for you now. And really the advantages I think that are the most lasting are the improvements in the team and the talent of the team and the systems and the processes of the team, because that's going to mitigate more risk than anything else. So with that, Sean, do you want to jump into your report?
Greg, can I take a quick time out before we jump into the report? I know we're going to jump into the report. We got a couple questions maybe we can knock out real quick and then jump into the report.
Love it.
Awesome. First, not really a question. It's an amazing comment with perfect timing here. Kath Schiffer writes, I want to thank Sean for his wisdom back in 2015. Following Sean's advice, we invested heavily with JWB and are on our way to a comfortable retirement. So it sounds like 2014 was tough, and then 2015 you were recommending people, huh? It's a good turnaround, man.
That's great. That's fantastic.
Yeah, that's awesome.
Kathy,
thanks, Kat.
Thank you so much for sharing that. That's amazing.
Yeah, very cool. And then Miguel Angel Sanudo has a question here that I think is on the minds of folks based on these numbers that we're looking at and what we're going to continue to look at here. And you just kind of alluded to it, but he says, I presume you already mentioned it, but I've been noticing that house prices are growing faster than rents and diminishing ROIs. Any insights on like what to expect? You just kind of mentioned this idea that you're making up with it by the ability to service the house and do that type of stuff, GC. But any kind of like perspective on that?
Yeah, absolutely. Sean, Miguel Angel, what you're pointing out is absolutely correct. And it is going to continue because these are market forces that are at play here, right? Home prices, because of the severe lack of supply, and the large amount of demand that we have, because of population growth in Jacksonville and other markets, because of low interest rates, low supply and high demand equals high home prices. And that's why I'm really confident home prices are going to continue to go up next year. Because at the end of the day, the way to correct that equilibrium is to build a lot more houses. And there's just not enough time between now and then to buy that land, for builders to develop that, for developers to develop the land, for builders to build that land, for it to hit in order to equalize that equilibrium. And so you're going to see home prices continue to go up faster than rents. Rents are going to continue to go up too, but they're not going to keep pace with home prices. And so what you're pointing out is very real. We've been talking about this for, 2 years now that we've almost been doing this show, which is pretty cool, Pablo. Can you believe that? It's almost 2 years now we've been doing the show. And so what you're going to see going forward is what I have been saying for a very long time. Your returns on investment today, from everything not including home price appreciation, your returns on investment today are higher than they are going to be tomorrow. And it's because of exactly what you're pointing out. Home prices are going to continue to go up. They're not going to keep pace with rents, and your monthly cash flows are going to go down. Think about this. You've got kind of a perfect storm happening. You've got high home prices that are going to continue to go up. You've got interest rates that are going to go up, right? when both of those things happen, your cash flows get compressed. Your rates of return get compressed. Now, is it all doom and gloom? No, because number one, even if your cash flows go down, which I expect they will, comparing this to your other asset classes, you're still going to look at this and probably say this is a better alternative. And then the other side of this is if I'm saying that the reason that home prices or the reason that returns are going down is because home prices are going up, well, guess how you can take advantage of that? You can buy now while interest rates are low, and you can walk in with what I would expect would be a nice bump in home price appreciation, which is certainly not what I told Sean back in the day. So there's always pros and cons, but I think you're 100% right, Miguel Angel. Cash flows, returns are going to continue to be compressed because of the market forces that are at play here.
All right, GC, let's open up that client. Lee's got a great question, but I think it's going to go well at the end of the client ROI report. So I think we talk about Sean's journey here on the ROI report, if you got it.
All right. And Sean, thanks so much for being a trooper here and allowing us to look at your client ROI report here. And for those who aren't familiar, who aren't clients yet, this is the client ROI report for Sean is exactly what you all will have as clients. Now, this is something that we produce every single month for all of our clients. It's our accountability measurement tool. It helps Sean see where his dollars are going. It helps Sean see what his return on investment is, how hard is it working. And it helps Sean hold us accountable. When we told Sean you should expect a certain amount of return on investment from that property evaluation, we got to show up every single month and be accountable for it. And you can think about how beneficial this is for my entire team as we continue to get better and better and better every single day, every single month, every single year. When we need to show up and produce for clients, we believe that is what is going to make us a great company for many years here. So with all that being said, Sean, I'll kind of walk us through this a little bit, and then I'm going to ask for your real-time stories when we start to look at 2014. And we're going to look at just how bad it was on certain properties here. At the top here, for those who aren't familiar, we're always going to want to know what's driving this investment for you and what your goals are here. And these are some of the goals that we put together for Sean early on. You can see now his portfolio is complete and he has 6 properties with us at JWB. These are his key performance indicators. This lifetime return is taking into account all of the good things that have happened, all of the bad things, including maintenance costs, vacancy costs, tenant placement fees, and it's not including home price appreciation. So this massive amount of home price appreciation, not included in those 19.7% returns, which is wonderful. 9.5 years investing. We're almost at our 10-year anniversary, Sean. That's pretty incredible. Thank you so much for all of your trust all along the way here. This $132,000 is the net rental income. This is taking into account all of everything that's hit Sean's bank account, basically, from his rental properties. So it's the gross rents that are coming in minus all of the expenses that happen, minus all the maintenance costs, vacancy costs, tenant placement fees. It's not including tax savings and principal pay down or home price appreciation. That's just real what's hit his bank account. Mm-hmm. This $264,900 here is the total return for everything, not including home price appreciation. You're not going to find home price appreciation anywhere on this report. This is just taking into account net rental income plus principal pay down plus tax savings. So $250,000 there, a little bit more than that. Sean, congratulations, my friend. This is just so fun to be a part of for you.
Yeah, I just would like to go back in time and buy a few more properties in 2012.
The funny thing is I say the same thing. I mean, we are investing together here in Jacksonville, and this year we're blessed to, we'll buy just around 1,000 properties here in 2021 for JWB. And I look back in past years, and I'm like, oh man, why weren't we buying 1,000 properties every year? Man, what if I could go back to 2011 and buy 1,000 properties, right? We all go through that. So this is the next step of your client ROI report. We won't spend that much time here, but you can see here that these are all 6 properties for Sean. You know what? Actually, let's spend a little bit of time here, Sean. This is the fun part. I forgot about this. You can see 3 of Sean's properties are on India Avenue right here. Does anybody remember the property address of the property of the week? Well, what do you know? I got it right here. 8601 India Avenue. And that property is just put under contract at a purchase price of $206,000. Sean, I see a different number here for your purchase price. Would you care to elaborate on what this figure means?
It's like an out of body experience, you know, to think that we could purchase a property at that amount and still get $1,100 rent. I mean, it's mind boggling. I mean, it really is. But at the time, again, okay, this is 2012. This is the spring of 2012. What did we just go through the previous few years with the financial crisis and everything else? I mean, people were, and believe me, it took a little chutzpah to get to do this because everybody was timid.
Mm-hmm.
You know, everybody's reluctant to put money into something, but I figured it's going to be a long-term thing. And that purchase price is, like I said, is unbelievable. It shows you how times everything changes. Look at the interest rate.
Yeah.
You know, you got almost 5% versus now. So that was a negative for then versus now, but still we went ahead and did it. But I'm just glad we executed, because back then nobody knew what was going on. And Gregg, you and I talked numerous times, and hey, Sean, we don't know if your property in 5 years is going to be worth 110 grand. You know, we just don't know. But focus on the cash flow. And when I took a look at this and realized, you know, we were financing 80 grand or so, and what the monthly payment was, and you do the math, and it's like we could still come out with like $300 or so a month in each property. You know, I mean, that was the clincher. And there you can see. Well, we don't have the exact rent there, but if you take 102 grand, I know for sure we got over 4 figures rent. It was probably 1050 or whatever.
Mm-hmm. Yep.
What an amazing, beautiful thing. So when I look back at that, like I said, it's disbelief.
Yep. For you, it's risk mitigation first is what drove you here, because you looked at the cash flow coming in based on the rents compared to the price. So risk mitigation first, and then you want to be in the game for upside. And you are definitely in the game for upside. And it's been amazing. All right, let's look at some of this. Let's put into real numbers how it felt to go through some of those tough times. So what I'm showing you here is our individual investment ROI report. Again, every property that clients purchase has this, and there are some really fun numbers that you get to see here on an individual property basis. I won't go into every single number here, but what you can see is that every year we're seeing how our returns are performing. And this is really cool. We get to see what are the actual annualized lifetime returns versus what did we expect Sean, or what did we tell Sean to expect right now? There's your accountability measurement. This is something different. You will never see this. I don't like to say never. I have yet to see another turnkey investment company out there that has this type of reporting. This is something that's standard. We think it's critical to our success. So Sean's actually been investing since 2011. He actually broke our client ROI report. He's been investing so long, and we only show the last 7-8 years or so here. So you don't see 11, 12, and 13, as Sean was talking about. Those were largely very positive years. But let's look here. 2014, I was just taking a look at this property on India Avenue. And this is really where I think Sean was thinking about throwing me off the plank there. Look at this. Maintenance expense, almost $8,000 in 1 year on one property, right? When we talk about an outlier, this is what we mean. This is not normal for a property turn or property expense, but can it happen? Yes. And if you invest in 10 or 6 properties over 10 years, is it likely that you will have one of these? Yes, right? You've got to be able to handle this. And of course, it makes it a lot easier to handle this when you have a diversified portfolio like Sean. Sean, anything to add there?
Well, if you take a look in 2016, we also had this particular property. Take a look at 2014 maintenance And then a couple of years later, and then 2019, 2013 also, at the end of it, 2013, you know, there were some big numbers.
Mm-hmm.
What I wanted to communicate to everybody is the numbers don't always reflect, you know, the feeling in the gut and the stress when it's like, hey, the folks at JWB, phenomenal, but every time they call, it's to be like, okay, what now? You know, that kind of thing. But you have to get through that because, you know, your experience is going to come. It's that return to normal, you know, and we just, like I said, we just got hit with a wave, and we got hit with many, many years of negative outcomes, expenses, et cetera. And
Yeah,
we just,
your property
it
turns.
was like we were a magnet those 2 or 3 years for all the bad stuff, you know.
Your
But
maintenance cost has been higher than normal. I mean,
Yeah.
we can absolutely talk about that. I mean, on a percentage basis, it's higher than normal. But what's
But
really
Greg, if you
interesting,
go up to the other, was it 8412? If you go up, it's like, even we had some things going at 8412 too, because you know, there's only single digits there versus the fantastic percentages in certain other years. So this is part of the whole thing too. We didn't always have a negative return on investment. We had some huge effects though, which brought it down to 3%, 4%.
which is
Lately, it's been a whole, we've had more normal kinds of experiences.
and we're gonna round out with that right now. We're gonna take a look at this because on an individual basis, well, I wanted to point out, even though this has been higher maintenance costs, look at this. We expected 19.3% on the evaluation, 19.7. So that's why I talk about. There's going to be ups and downs over the long haul. It's going to come right back down to these expectations.
Right.
And you got to be able to look at this like an investor and a portfolio mindset here. So we're going to round out by coming down here and taking a look at this total portfolio return. This is taking the weighted average of all of Sean's investments with his initial investments, those down payments for those properties, the timing. It's taking it all into account. And what you can see is this is the greatest measure of how Sean is feeling, right? Because if these numbers are consistent and going up and better than expectations, Sean's going to be a happy camper, right? Even if some bad things happen in here, Sean's going to be a happy camper. I know Sean wasn't a happy camper in 2014 because he had a really tough year. It should be pointed out, though, that even though it was an outlier year because of the other profit centers, he still earned a positive return on investment, not including home price appreciation, the value of tax savings, the value of principal pay down. And you can see overall, the lifetime returns for the entire portfolio are just like we talked about roughly for Sean, again, not including home price appreciation, which I think you guys can see now is substantial and would significantly increase Sean's actual return on investment if he was to sell, which he's not planning on doing. So,
No.
Well, Greg, we got a question from Lee that he asked a little while ago, and I think at this point it's really contextual before we wrap up the call. But he says, you know, did Sean reinvest to get better rates, or are the 6 houses paid off yet? Is he going to cash out and refinance to purchase other houses? Right? Like, have you thought about it, Sean? What you're going to do with all this equity? Yeah,
we're going to refinance. Just started the ball rolling on that. That's an excellent question because, well, the oldest daughter that is friends with Gregg's sister, great friends, she and her family have been living with us for the last year or so while their house got done. It just got done. So now my wife and I have a chance to breathe a little bit. So we're going to dig into these kinds of things. Believe me, because having that positive equity is a very good thing. So that was a great question.
Yeah, and can we use that as a kind of teaching moment of, you know, asking for a friend here? What does that mean to have positive equity in the house and refinance, and what kind of options are out there?
Well, for me, it's like, what do I want to do with that money? Like, Gregg has got this great lending program, never failed, 10% interest. If you're dishing out 3.2% on a loan and you can make 10, it's a beautiful thing. So that's one of the things we're going to be looking at doing. Yep, absolutely.
All right. Gregg, you have any context to add on just like how somebody would refinance or anything like that? Is that something that the portfolio manager helps out with?
Yeah, absolutely. These are conversations we love to have. We get to have them all day, especially in an environment like today where we've seen 15 to 20% appreciation, especially clients. If you're a client that has owned properties for 3 years with JWB, definitely 5 years, maybe even less, you may be able to pull out significant equity by refinancing. I won't get in all the numbers with it, but I would encourage you to sit down with your portfolio manager so we could build out a plan for you. And really, the opportunity here is if we understand that in order to accomplish your financial goal, you need to have 8 properties in your portfolio and you're at 5 right now, you may be able to buy those properties today without bringing any additional cash to the table. Maybe be able to lock in an interest rate of like 4% or somewhere around there. And you may be done with your real estate part of your financial portfolio, which is a wonderful thing. If you were thinking about buying 8 properties over the next 3 years, let's knock it out right now while it's the most advantageous time. And the cool thing, as we mentioned, we can engineer this thing so that you don't have to bring additional capital to the table. It's already sitting there because you made great decisions in the past. And with the lending opportunities today, you're allowed to take advantage of that. Remember that, equity is a wonderful thing. And I love making sure that we're conservative, right? We're not going to take all the equity out of all of our homes. But if you're sitting there with 50% leverage on your property, right? Banks lend up to 80%. I think banks are pretty conservative. For you, you have a spread there. You have equity that is returning 0 for you at that moment. Your return on equity is 0 if it's not used. And so now that doesn't mean go off the rails and leverage everything to the hilt and go buy big screen TVs. You need to work with a team of professionals that can help you. But this is something that we get to do every single day to help people accomplish their passive income goals. And now is the best time to take advantage of the powers that be to be able to do this now.
Love it. Love it. I love equity as options. That's a good one. This is a great call, fellas. We're over an hour, tons of value, great reviews here in the chat. Sean, a bunch of people thanking you for sharing your wisdom and sharing your journey and all the great advice. It's really just like a privilege to be able to kind of like peek into the brain of somebody that was making this decision right after the housing collapse and then just analyze it now and talk about the vulnerable moments and all that stuff. I think, for the sake of clarity and transparency, which is what this show is really all about, is this access to the type of thinking, access to what really is to be a not your average investor, insanely valuable. So I know that I learned a lot, really, really enjoyed it. I want to thank everybody for being on this call. Doesn't take, the fact that you take an hour out of your day to be here and be here an hour plus still here on, we still got 30 folks on with us, just never goes unnoticed by us. And it's really an honor. And next week is Gregg's birthday on Tuesday. So if you show up for the show next week, we're going to be celebrating GC's birthday. GC, what's the subject for next week, man? I actually don't even,
I know.
Oh,
it's
well,
what I want to talk about on my birthday. It's the Jacksonville real estate market update for Q4.
There you go.
Yeah, that's you gave me an opportunity to celebrate my birthday. I'm coming strong with a market update.
Yeah, you are. Yeah, you are, man. So anyways, we like to say it, right? If you came here to find out about rental property investing, you're in the right place. If you wanted to find out about best in class property management, right? Like the materials and the things that JWB has learned along this journey for rental investors, you're in the right place. If you want an edge in the Jacksonville market, show up next week for GC's birthday. You're definitely going to get an edge on the Jacksonville market. But if you want a customized plan, go to chatwithjwb.com. Sean, thank you so much for doing this. I'm gonna give Gregg last call here, last words.
Thank you to everybody for being here in this community. I think we've really kind of stumbled upon something here as far as having more stories really matched right alongside the property of the week. Sean, I want to say a big thank you to you for being our first guest expert here, helping us analyze the property of the week and also sharing your real experiences. This has just been a really, really fun trip down memory lane for me. And just wanted to tell you how much personally it meant to me for you to be able to trust me and the team back in 2011 when we didn't have a whole lot of success and experience to show for it. You really took a leap of faith. And I think for a young business owner back then, knowing that other people trusted me, that you thought I was worthy of your trust, meant
I
all the
appreciate,
world.
yeah. Like I said, had a fantastic vibe, and the work ethic and the follow up and everything was just, phenomenal. And the only thing I want to ask is what coffee Pablo uses, because I want to try that to get extra energy, being old.
I don't
So,
think it's legal in the States.
yeah.
I drink a ton of water every single day, and I swear that that's my energy source, right? And so, but I appreciate it, Sean. Thanks. The truth is that I'm living out this dream of being able to just connect people through a transparent form of market education that leads to business development. So I'm just really, really pumped up to show up every day. I love how GC shares knowledge. I love that there's people in the chat that met in a Zoom chat and now are rooming together in a hotel for our meetup that's happening in early December. So I'm just like self-actualized, and that's what pumps me up about here. And I feel like getting to talk to guys like you and people like Jen and the folks in our community is just really fills my bucket. So I appreciate you acknowledging that, but it's because of you, man. I appreciate it.
So, Gregg, thanks for the heartfelt comments. They mean a lot. And it's been a great experience for my wife and me. It really has. And
Awesome,
it's been, I'll just finish up by saying it's been an honor to be the first guinea pig on this format. So it
you
worked
set
out
the
great.
bar high. You set the bar high. We hope you come back in the future too as well. I hope you keep tuning in. Please tell Joan and the family that we say hello.
All right, we'll do it.
All right, see you.
See you next week.